Hello everyone. We're delighted to introduce to you Canara Robeco Multi-Cap Fund. This is going to be the new fund offering from Canara Robeco Mutual Fund. The fund will be offered between 7th and 21st of July 2023. We are here to introduce Canara Robeco Multi-Cap Fund to you guys. We will debate two aspects one related to category, second related to portfolio strategy. The first part my colleague Vishal will cover. The first part would be what are the traits that this category offers to the investors, what is the kind of solution this category offers to the investor. Let me welcome my colleague Vishal Mishra to actually take you guys through the first part, and then I'll actually return back to discuss the second aspect.
I'm Vishal Mishra, co-fund manager for Canara Robeco Multi-Cap Fund. Multi-cap funds have a minimum 25% allocation in each large caps, mid caps, and small cap companies, with the fund manager having the discretion to invest the remaining 25% across market capitalization. This 25% minimum allocation in each of the market capitalization categories ensures that the fund has exposure to companies across market capitalization throughout the market cycles. Historical data suggests that returns vary across market capitalization and no one category consistently outperforms every year. So, we have large caps doing well in some years, mid caps in others, and small caps outperforming in the remaining years. It is hence difficult to predict which market cap segment is likely to outperform. Multi-cap funds, by remaining invested across market caps at all times, ensure that the opportunity cost of missing out on outperformance of any one market cap segment is minimized. As multi-cap funds are required to invest minimum 25% in each of the market cap categories, they tend to be more diversified than the other diversified strategies. And this ensures that the funds are better positioned to participate in any uptick in the broader markets. Multi-cap funds also give the investors the opportunity to participate in the life cycle of a company. As a company grows from being an emerging business in the small cap segment to a relatively established company in the mid cap category to finally becoming a large cap company with a matured business model, multi-cap funds are able to remain invested. This is possible as multi-cap funds have more leeway to continue to remain invested in the company even when there is a change in the market capitalization category for the company. Finally, multi-cap funds give the investors the opportunity to participate in the broader markets while minimizing risks and drawdowns. While the minimum 25% allocation each to mid and small cap companies helps the investors participate in the broader market returns, the minimum allocation of 25% in large caps makes the returns less volatile. It also reduces the possibility of generating negative returns over a 3-year rolling basis. So, to summarize, the multi-cap category is most suited for investors who are looking at risk-adjusted returns from the broader markets. Thank you.
Now, post looking at the advantages that the category offer and the solutions this category offer, let me take you through the strategy of the Canara Robeco Multi-Cap Fund. The portfolio will consist of two parts. One will be portfolio stability and second will be alpha generators. Let me take you guys through each of them one by one. Let us start with portfolio stability. When you think about portfolio stability, the portfolio stability to portfolio will come from the ownership of kind of businesses where the earnings visibility, resilience is very high. Inherently, there is earnings compounding, which means these are the businesses who have leadership traits where ROE, ROCs are good. Inherently, these businesses are present across the market capitalization, be it large cap, mid cap, small cap. But because of the kind of business traits that they have, they provide longevity and revenue visibility. So this will be the first part, which will ensure that you own kind of businesses which gives you base return. They are very, very resilient. They come across market capitalizations, be it large cap, mid cap, small cap. And at the same time, the largest trait that they offer to you or to the portfolio will be that they will ensure that the drawdowns through cycle are very limited. So that will be the first part, which will be approximately half of the portfolio in terms of construct broadly. The second part of the portfolio will be alpha generation. Again, this will be approximately half the portfolio. How we intend to create alpha in this portfolio over and above the stability and compounding of the first part of the portfolio would be as follows. There will be broadly three buckets or three ways in which we intend to create alpha in this part of the portfolio. The first would be the businesses which are leaders or challengers themselves, but the leaders and challengers with relatively higher ROE, ROCs and niche nature in the respective segment, but at the same time in segments where it is not only compounding of earnings at low double digit, but the businesses where the scalability is high, where the scalability of either the business or sector itself is very high, and thus they are offering you earnings compounding at a much superior rate. That will be the first bucket which we intend to play in this part of the portfolio. Second bucket would be the cyclical turnarounds, the businesses where either the sector or individual security is going through cyclical turnarounds, and these turnarounds can happen for multiple reasons. These turnarounds can happen at security level, or at an individual stock level, or an individual business level, because the operating or financial leverage is playing out, or the capital allocation nature of the nature had changed at the company level, or the company has diversified into some related area which is actually has brought in the earnings growth, superior earnings growth to the business. Those could be security level reasons. There could be sector level reasons whereby the sector itself is actually coming out of the bad patch. The sector itself is coming out of a credit cycle. The sector itself has undergone a learning curve whereby the capital allocation of the entire sector is changing, and thus the re-rating happen. Inherently, we are actually trying to play here all those aspects which will lead to earnings and multiple re-rating. That will be the second bucket, which, as I said, will be cyclical turnaround. So first was superior growth compounding machines. Second will be effectively the cyclical turnarounds, and third way in which we intend to create alpha in this bucket is effectively a play on allocation, which means how do you play sector weights. So every time we will be constructive on a particular sector, we intend to go down the market capitalization curve. Our experience tells us that during the earnings upcycle of a particular sector, typically mid cap and small cap tend to do well. So what we intend to do in this part is that whenever we are constructive or very constructive on a particular space, our entire overweight positioning will reflect through multi caps and small caps, and vice versa. When we are less constructive in a particular space, in that space we'll move more towards large cap and we'll reduce our allocation to mid cap, small cap. So third part of this alpha creation on the alpha generator part of the portfolio would be through moving your sectoral allocations based on market capitalization. When you are very constructive, you move towards small cap, mid cap. When you are less constructive, you move those weights towards large caps. So those would be the three buckets that will play in the second part of the portfolio, which is alpha generation. One, basically the superior growth compounding machines. Second, the cyclical turnaround stories, and third will be reflecting your allocation calls through market capitalizations rather than just the overweight, underweights at sector level. So as we discussed, to summarize, this category clearly offers you three key advantages. First, it offers you diversified and broader market allocation. One. Second, it offers you wealth creation through life cycle of market capitalizations, be it small cap, mid cap, large cap. And third, it offers you optimal risk return equation. And coming to the fund, the key strategy advantages that we are offering here is the portfolio will be an optimal mix of stability and alpha generation. The stability part would predominantly come from niche businesses across market capitalization who reflect leadership in capital efficiency and who give you very high visibility and compounding of earnings. And the second part, which is alpha generation, whereby we intend to create alpha through three sources: the superior compounding machines, one, the cyclical turnarounds, two, and third, alpha creation through allocation of weights within the sectors towards the broader market, which is small caps and mid caps whenever you are constructive. We believe that multi-cap offers great solution to broader market participation for a lot of investors. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.